All right, hello everyone. We're going to get started here. My name's Stephen Paul, and I'm a business development associate here with SSQ. Before we get started, I just wanted to thank you for taking the time out of your day to join us today for this business insurance planning webinar with SSQ Insurance. I'm going to pass it over to Jos Herman shortly, who will be presenting today, but I just wanted to share some exciting news with everyone first. So SSQ Insurance is very pleased with the decision by AM Best Company to upgrade the credit rating for SSQ from A- to A excellent. The rating agency recently published its analysis with the increase to SSQ's rating, highlighting its excellent solvency ratio and the company's low debt. The agency also indicated that the excellent return on shareholders' equity, earnings, growth, and sound risk management contributed to the revision. This is great news for SSQ as it shows the company's development and fantastic growth. And just on one other note before we get started, as there are a lot of attendees here, all questions will be answered after the webinar. And you can either put those questions in the chat box or you can reach out to us here at SSQ and we'll be happy to help you out. So once again, thanks again, and I'm going to pass the presentation over to Jos. It'll just take 1 second and then we'll get started.
Well, good afternoon to everyone across the country, and thank you for joining us today. As Stephen mentioned, I'm Jos Herman, and part of my business in terms of resources and solutions is I get to meet many folks in many different areas. So I help advisors and clients. I do workshops and educational sessions like this, and I work directly with accountants in the tax and estate planning world, and to try and understand insurance. So like I said, I get to chat with many people across the country. And by doing that, we're going to try and slip the slides here. We get to chat today. So we'll make it sort of an informal discussion in terms of insurance planning for business owners. And we'll talk a little bit about the estate, which is really important when we talk with business owners, et cetera, or non-business owners, how the insurance can fit into it. And then look again more deeply into the corporate side for life insurance for the business owner and some case studies and where insurance can fit and why. So let's start with that. Let's start with the estate. And again, when I'm thinking about having this discussion with clients and having them focus on the estate, you get a varying bunch of answers and questions from clients. But I remind clients, even when I'm doing client seminars for them, I remind them that everyone in Canada will have an estate. And I pose the funny question out to them, and I always say, do you want your estate to be $1, or do you want it to be $1 million or $10 million? And you kind of get a sense then of what the client's mentality is. If they're saying they want their estate to be $1, maybe that means that they are giving it all to charity. Maybe it means that they want to spend it all. Maybe there's a little bit of turmoil in the family unit, and they don't want to give anything to their kids. So I think it's always a good foundation to start with the estate and that question of what that estate could potentially look like for the client. I always say the estate and the client has choice. And the choice and how they distribute their estate is theirs. And again, I love my little triangle there and our folks at the bottom in terms of CRA. And I think of who wants to give more to them. And so, it's kind of a great discussion point when you're talking with your clients and their feeling about, do they want to give, be a good Canadian and pay their tax, or is there potential tax savings when it comes to their estate? My thought is, if we do give more to CRA, it's sort of an inefficient system to try and then distribute then, to our heirs or the community. So I think there's an opportunity from a efficiency standpoint to maybe have CRA not as our number one contributor to our estate or our wealth, whereby we can give more to our heirs and perhaps they can give more to the community, etc. So again, another good discussion point when we're talking with our clients. If again you're looking at some of those right questions to ask and where the conversation can go, we always have to think of, do your clients and even yourselves, do you have the right documents in place? And most importantly, are they up to date? And so we'll look and explore some of those things in sort of my next slide here. It's all about asking the right questions. And so we'll focus a little bit on wills. We'll look a little bit at, shareholder agreements or partnership agreements or joint venture agreements. And so if I think about then the last point about fair market value, it really has to do with that business owner that is, thinking about, well, what is my business worth and how does that impact then my estate? So let's look at the will. If you ask any client, and like I said, I do client seminars, and I almost stopped asking that question of, do you have a will? Because there's almost shame in clients putting up their hand to say, you know what, I don't have one. So there's many reasons why a business owner may not have a will. It may be that, again, it's fear, the fear of they don't know what to put in there. This idea of, well, I'm not going to be here anyway. It doesn't matter. So it does matter because, again, if you do not have a will in Canada, you have to look at then different acts across the country, be it a Wills and Succession Act or Succession Law Reform Act, that sort of dictates then who and what and who's going to receive your assets when you pass away. And when it comes to then that idea of who's going to receive your assets, and if you have no control of that because these different acts play into part, then it doesn't consider any particular family member or any unfairness in terms of distributing their estate. So again, if there is a family member that has a disability and they may need more, and if you have no will, it's really hard then to distribute and give more to that particular child or individual from that circumstance. So again, I always sort of leave our challenge to our clients at the end of any of my seminars to say, you know what, today is the day, or this is the year that you're going to start drafting your will, because it's really important. We want to have you maintain the control of your estate and your business and who's going to receive it, etc. If the client doesn't have a will, I guarantee they don't have a shareholder agreement. It's it's a document that outlines what happens in different events. And so a shareholder agreement is for those corporations that have shareholders. If you're in a partnership, then you would have a partnership agreement. And the same holds true if you're in a joint venture and you have joint venturers. If we look then, if I've got different parties inside my corporation or etc., there's 6 events that can impact the relationship between different parties. And so again, death of one of those members, death of one of the owners, disability, bankruptcy. So again, you may have a shareholder that currently likes to enjoy going to the casino or whatnot. What happens upon marriage breakdown? So again, we all know the stats with respect to that, and we'll focus a little bit on that later in my presentation. And then what happens if we just don't get along? All right, so again, disagreement among owners. So a shareholder agreement can outline what happens in the event of these certain things. So we all know as insurance professionals the importance of, again, talking about having death, and looking at that, what's the consequences of the shares passing on to other people. So let's look at the circumstance of maybe you don't want the spouse to inherit the shares in that particular business for particular reasons, i.e. they don't have the business aptitude, or they maybe because of other personal reasons that may not be a good fit, etc. And then disability, again, it can happen. So the shareholder agreement can potentially address that. And we all know that we certainly have insurance products that can deal with both of those events. So I always want you to encourage then your business owner client then to think about this as a business will, all right? The business will dictates what can happen and how do you then protect your client in any of those particular events, and especially with insurance. So again, another document that we should be talking with our clients about and either having them implemented or being updated. In terms of fair market value for business owners, the business may start off at $100. But it can grow over time, obviously, and that's the goal of any business owner. So again, it may grow to $1 million, it may grow to 10 million. So if I think of the circumstance here with George and Nancy, they just run their business. They're in hopes that they'll have net income, and then hopes to have a business that grows into the millions. So in asking what the client's perception of what do you think the value of your company is worth, they may or may not know. And they may know because maybe, George has a competitor across the street and he knows that that competitor sold his business for X amount. The conversation could be with the accountant to say, you know what, the accountant kind of looks at that for me, or we've talked about it in the past. And so that's another good gauge or an opportunity for you to have those discussions about fair market value. Why fair market value is so important or to determine is because I always encourage advisors to gather that net worth statement for their clients. So again, what does the net worth statement look like personally, and what does it look like corporately? So again, we can get valuations or real estate values for principal residences, any other recreational property or commercial property the clients may have. We can get investment statements, but again, when we look at the value of corporations, it all depends on what industry the client's in, what's in those corporations, and this is a really good then opportunity to have, like I said, those discussions with accountants to sort of help us in the to gauge that value. So again, net worth statements help us then determine what's the tax liability. So again, in Canada, while your client and their spouse are alive, I always say a tax burden is growing on their assets. And at death, assets generally pass on to that surviving spouse on a tax deferred basis. So it's a really important word when we think about that. And so many of those tax deferred assets, i.e. companies and real estate, etc., become fully taxable when passed on to the next generation. So I always love having the conversations with G1 and G2 in the room because, G2 could be facing a large tax liability that was brought on by G1. So again, those conversations need to be had because they may not be understood at that time. So I always go through the exercise then of, okay, if we have, and we can sort of confirm fair market value for each of the different assets in their net worth statement, is there a tax impact upon death? So in Canada, we have a principal residence exemption, and based on the number of years I hold the property. But if they've got other types of real estate, that tax impact certainly looks different. And then we've got different assets, like I said, RSPs, is there a rollover? And again, is there the tax impact when it comes to our businesses and in terms of operating companies and holding companies? So go through the exercise then. Talk with your clients. Will there be a tax impact or not? Or is there ability to have that rollover to any spouses? Because that then leads us to doing maybe a preliminary calculation for our clients when it comes to tax liability. They may know that, okay, well, I know my real estate's worth, $1.7 million, and then they bought it for, let's say $400,000. So I encourage you to find, a template or some type of calculator that can sort of look at what's the capital gain that for each of the particular assets. And what you can do then is say fair market value minus the ACB, and then determine capital gain. You can even extrapolate that out into the future for life expectancy and do that for each of the particular assets that the client has. And then, like I said, if then you need some help in determining what the fair market value is for the client, then you can go back to the accountant and say, you know what, we're doing some preliminary planning and financial planning or estate planning for the client. Can you help us sort of confirm some of these values, especially when it comes to the corporation? Because if we look then at the corporate side of this disposition for, let's say, go back to George's situation, and we assume that maybe Nancy has already passed away, George is deemed to dispose of those shares at fair market value. So he can't pick a dollar, etc. And so the calculation when it comes to determining or tax liability for our clients when we look at corporations is, again, what's the value of those shares, less the ACB or adjusted cost base of those shares. And usually it's about $100, a really low number. And you ask, well, where does this number come from? So I always encourage advisors to get the financial statements of your clients. It's outlined in the share capital of any of those financial statements to sort of get a gauge of if it's $100, et cetera, or if there has been any other restructuring that have been done, and if it's a higher number. That then gets us to the capital gain number, so fair market value minus ACB, and we have a capital gain tax rate of about 25% if I look across the country. Some are higher, some are lower. And so for George, he's looking at about a $2.5 million capital gain. Big number. Your clients may have add zeros and minus zeros, but again, what's the tax impact upon death? If we then look at what's the tax reporting requirements for, the executor to say, okay, well, George has passed away, he had these shares of $10 million, the accountant then has to file tax returns. So that T1 that we just looked at. So if George passes away between January and October, that tax return needs to be filed by April 30th. If George passes away between November and December, file within 6 months. This is a really short amount of time. And the reporting or the tax return has to be filed by a certain date, and CRA wants their money. So again, I think about, is there a liquidity issue that happens or need? So it goes back to the net worth statement. Is there assets that can be liquidated, or is it a sort of a non-liquid type of assets that the client has? But these filing reporting requirements and CRA's requirement to want their cash happens in a short period of time. So I've had discussions with accountants to say, you know what, we're dealing with a liquidity issue. This is why the insurance is needed, even though the client has, multi-million-dollar real estate in hand. So let's talk a little bit more about estate obligations then, because the biggest one we just talked about is the tax liability for our business owners. And here's sort of a court case that I wanted to bring and highlight the impact that a business owner may face when it comes to estate obligations and actually insurance. So this is an Ontario case. It's Bernie versus Bernie, and it happened this year. And why we came into this situation is because we had Michael and Janice Bernie, and they separated back in the early 2000s, and they had a separation agreement. In that separation agreement, Michael was required to pay spousal support payments, and there was also a life insurance obligation that was right inside the separation agreement. So as we know, client situations can change over time, marriages can dissolve. And so we have this situation where, again, a separation agreement has been drafted and insurance was actually put in, made note of, and there was a clause put in there. In that separation agreement, it actually stated the following: the husband undertakes and agrees to obtain a life insurance policy on his life in the face amount of $500,000. The husband will designate the wife as the irrevocable beneficiary under the terms of the aforementioned life insurance policy, with the beneficiary designation to continue for as long as the husband is required to pay spousal support. Okay. Where do we sit now? And why do we have this court case? Well, Michael, Mr. Burney, had passed away. And prior to him passing away, Mr. Burney had been paying his spousal support payments to Janice, but he did not do two things. He did not have the cost of living increase associated with those support payments, and he did not purchase the life insurance. So twofold. So here's Janet. Michael has passed away. This is now Michael was in a second relationship. And then Janice brings a claim against the estate for $500,000 because there was no insurance policy that Michael had put in place. And she also made the claim for the cost of living increases on the spousal support payments. So the judge had to decide, is this a standalone clause? And if so, the estate would be liable to the former spouse for the entire $500,000. Or if the clause was only intended to secure support payments, then the estate would not be liable. And this is because the deceased, Michael, had been making those support payments along the way. So when we think about the importance of having these insurance clauses in there and the reasons why insurance would be in place in these separation agreements, it's happening more and more. So what did the judge decide in all this? He said that the language in the agreement didn't clearly indicate the sole intention of the insurance clause was to secure those support payments. And there could have been a number of reasons why it was to benefit this former spouse, i.e. Janet, and was it for affection, appreciation, guilt, or regret? So because of that, it was a standalone clause and he found that there was no other language to determine otherwise. He favored in Janice's decision. So the estate had to pay $500,000 to Janice because Michael failed to buy the insurance policy and also the cost of living increase that she also claimed on. Here's the important lesson when it comes to all of this. The importance of clear and proper drafting. And again, these existing legal obligations can have an impact on your client's estate plans. So if there's any outstanding obligations at time of death, a court can find that the estate is liable for those obligations in priority of other beneficiaries. So this estate was worth $1.6 million. $500,000 had to come out of it. Add the legal fees, we're down to $1 million. So what's the lessons involved in all this? Because again, this happened to be a lawyer. Michael was a lawyer. He had his own practice. He had his own business. He had corporate insurance. So again, it wasn't Janice as the beneficiary or anything like that. He did not have personal insurance. So when I think about, does every business owner, is it always a corporate insurance case? Not necessarily. You can see that definitely this was one where Michael should have purchased personal insurance along with the corporate insurance that he had already had. In terms of the lessons for the advisors, I always think of if you are the advisor for Michael, you need to know what the client events are happening in his life. To know that he's been separated from Janice, to know that there is a potential separation agreement, and is there insurance in place? And have the discussion with, say, Michael, again, there's cases out there, and be aware that you do have this obligation, so let's look to implement that insurance. In terms of Janice's situation, if you're her advisor, again, you know that she's gone through the separation, look to have a copy of the separation agreement and identify, yeah, there's insurance, and why was it not put in place? So again, lots of lessons here, especially for business owners where not every time it needs to be corporate. There is definitely a obligation here. And at the end of the day, Michael could have solved this, and his estate could have solved this quite readily with an easy $500,000 insurance policy. So when we think about then those opportunities or where business owners look to, where they need insurance, I always think of different areas. And so I've always sort of thought of in little compartmentalized areas in terms of where business owners need insurance. So again, if a business owner has debt, so they've gone to a financial institution, they've gone and secured $2 million of a loan, any insurance company will certainly insure that. Again, that debt is still owing. And so if that business owner passes away, that loan can be paid off, and the CDA does not have to be used in those circumstances. So again, it can be used for other shareholders and or the estate. If I think then of key person or buy sell, I kind of distinguish these between two areas. Key person, so if you have those clients that have management level or the next successor to come into the business, then we want to make sure that we insure those individuals. If we look again back to our shareholder agreement, I use that as sort of a buy-sell situation. So again, we have the opportunity to insure both parties or multiple parties inside that corporation or partnership to ensure that, again, liquidity is there to buy out those shares, etc. We already talked about tax liability. It can be in the millions, it can be in the 100,000s, etc. But again, we have an opportunity to at least make a preliminary assessment of that tax liability, and is liquidity needed for the estate. In terms of equalization, I always think of, you've got a business owner, maybe there's one child that has always worked in the business, knows, how to make the desks and tables, and then they have another child or multiple children that are not in the business. They either have become a doctor or a pharmacist or something, or they don't live in this country, different scenarios like that. We can look to potentially equalize in those scenarios for different children and not always have them brought into the corporation and deal with the ramifications after that. Lastly, I always think of insurance as an opportunity to diversify. So again, this comes down to looking at what's inside the corporation, what net worth does the client have? Do they have different assets in different types of industries, etc.? And insurance can be a way of means of diversifying that portfolio. So I always go back to the language of any sort of investment advisor, and they use that word a lot. What's in your portfolio? So think of that net worth statement as a portfolio. Is it full of real estate? Is it full of investments, etc.? So when we think about any sort of portfolio that sits inside a corporation, we all know that we've had those new passive investment rules that sort of made an impact then when it comes to the small business limit that we have here in Canada. So the small business limit in Canada is about $500,000. And if I have net income below $500,000, I pay a really low rate. In some provinces it's below 10%, and normally it's above 10%. Anything above is usually somewhere above 26%. So if I have, and I'll go to the next slide that sort of shows this in a graphic standpoint, if I have too much passive investment income and it's above $500,000 of investment income, it can reduce my small business limit by $5 for every $1 of passive investment income above $50,000. And my small business limit actually gets reduced to zero if I have more than $150,000 of passive investment income. So again, it's one of those rules that have come into play recently where we sort of need to know, is that impacting some of our clients? Do they have too much investment income that is impacting their company or a related company? So again, is the investment portfolio inside of a holding company that can then impact that operating company? Passive investment income, from a technical standpoint, is known as AAII, and we love acronyms in the tax world, and this is known as Adjusted Aggregate Investment Income. So that passive investment income that we just talked about is taxed at a really high rate in the corporation and it's well over 50% across the country and even more. And again, any type of investment income, i.e. rental income, interest income, any type of investment income, royalties, get taxed at this high rate. So I always look at, is there options for your business owner clients? Is there a way to diversify? Can we look to having tax efficiency inside the corporation? Again, does that mean implementing some type of permanent insurance solution in that realm? So again, if we go back to our 5 reasons for having insurance, insurance can play a part to bring liquidity and also bring diversification when it comes to a corporate setting. So I always think of then, what do we present then to our clients when we're thinking about having corporate insurance? And I always say we need to have a strategy we can show our clients, a way of presenting the tax impact and what the insurance looks like. And I've always said, in previous times, is we can't just keep showing our clients an illustration. The illustration doesn't show the do something or do nothing versus a potential insurance solution. So again, at SSQ, they have a strategy called the Corporate Wealth Note Strategy. And so I was able to access their software, and I wanted to kind of show you how this particular strategy plays out. So like I said, this strategy compares option 1, option 2. So option 1 in this particular strategy looks at an alternative investment. So i.e. if it's a portfolio or something where we deposit more cash flow into it. So again, $25,000 a year for 25 years. And yeah, we may have some growth in that portfolio, and maybe it grows at 4%, etc. Like I mentioned, this is passive investment income, and it gets taxed at over 50%. So in option 1, we're outlining what the tax would look like, and we would also look at what's the net estate value if the client passed away, if they did this type of planning, where they just put money away into a portfolio, etc., for the next 25 years. The other side of the strategy then looks at the insurance. So again, you have a whole host of options when it comes to that. So I just used SSQ's YRT, and again, male 55, and that gave me an initial death benefit of $1 million. And that's because I deposited $25,000 for that same time period, and I overfunded with it. So what I do know about insurance, it accumulates on a tax advantage or tax-free basis. So again, when I look at option 1 and compare those two, I've got an advantage from a tax perspective. And again, if I need to pay out any money, I've just applied any sort of dividend tax rate, which is about 45% across Canada, or higher or lower. What this strategy then does, it gives you some numbers. And so under option 1, we're looking at the alternative investment, and we're looking at the net estate value. So if this client has put money away corporately and he passes away, what does that net estate value look like, say, after 30 years? That number turns out to be somewhere about $629,000. And if I compare that then to that insurance YRT solution, where I have protection right away, and from a net estate value, the client at year 30 will have an estate value of over 1.1 million. So what this strategy then does is just compares 1 versus 2. And the nice thing then is you can have a discussion about which option makes sense then, client. And usually they'll pick 2. And that's because you've shown them the due diligence behind the one way of doing it or another way, which is the insurance. The other nice thing about the strategy that I found that is it comes in basically 5 pages. If our clients aren't sort of number oriented, there's also a graph there. So the green is the option 1 and option 2 is in the blue. So again, clients have a way of visually seeing that which choice may be better for them. The nice thing also is that it's right in the SSQ software. So you can do this strategy on a personal basis, and you can also do it on a corporate basis. So again, corporate wealth note strategy. And I know that the wholesalers and the inside sale team could be able to help you if you wanted to create this strategy. So once you've created the strategy, it's then about just talking about the benefits of corporately owned insurance and its attributes, right? So again, if we think about the different assets that are available for the client, life insurance has the attributes of that corporation receives the death benefit tax-free, it's tax exempt, I have flexibility in overfunding, and again, we've talked and used that language of liquidity. It provides immediate liquidity at death, and that's when it's most important. From a tax perspective, we also look at that important tax account, that notional tax account called CDA, Capital Dividend Account. So again, whenever I have corporate insurance and I have that beneficiary as the corporation, CDA or Capital Dividend Account equals death benefit minus ACB. So I want every Canadian to know what that acronym is. I want them to know what it is, because if I have CDA, it affords me the ability to pay out a tax-free capital dividend out of that corporation and provide liquidity when it's most important. So here's where we do need the help of the accountant. So having a capital dividend being paid out on a tax-free basis requires an election form, and it's T2054. So again, if life insurance comes into the corporation, like I said, comes in on a tax-free basis, credit to our capital dividend account, in order to pay a tax-free dividend, we need to file that election of T2054. The other conversation then, you're having it with the accountant, you're having it with the client, you're showing them the strategy, you're talking to them about CDA. You want to almost prove that insurance is tax-free and that there's no shareholder benefit associated with it. So again, setting these corporate policies up properly is so key. And so I sort of look to then to one of the technical interpretations that respect to corporate insurance. And what a technical interpretation is, it explains CRA's interpretation of specific provisions of the Canadian income tax law. And you can write CRA and say, I have a specific tax situation. Give me your opinion of what the tax treatment would be. So back in 2012, someone did write to CRA and said, give me your opinion. I have corporate insurance in this hypothetical situation for $1 million. Can you tell me that the death benefit from the corporate-owned life insurance will be received on a tax-free basis? And so CRA writes back, they create a technical interpretation as well, and they go through the exercise to the various pieces of the act, and they say at the very bottom there, consequently, the payment of a death benefit from an exempt life insurance policy is not a disposition and therefore can be received tax-free. So I provide this to the audience today because, again, you want to provide the client with pieces of the Tax Act that confirms different things. You want maybe the accountant to maybe have this. So it's a great reference piece for you, along with the strategy that you're trying to show the client. Let's look at a sort of another situation then in terms of a case study. So again, we talked about diversifying in the holding company, etc. Here's another one where I sort of call it a dual solution. And so I always think of insurance shouldn't solve, or one insurance in policy shouldn't solve multiple objectives or concerns or etc. So I always think about, is there an opportunity when we think about any type of planning for our corporate clients, should it just be one product? And so I have a doctor client, about 50 years old, has his practice incorporated. We're looking at about $1.5 million of insurance. He already has universal life. He's familiar with insurance. We had discussions about the capital dividend account. what it does, why it's needed. Again, he has tax liability at death. He's got real estate inside the corporation, so various things. So when you look at the potential solution for this particular client, doesn't mean just, plug and play of going with, just participating whole life or non-participating whole life or just term. Could we not provide a multi-solution where we layer on term and permanent? And here's maybe why. The permanent coverage, as we know, will be there, and that's always what he's going to need from a tax perspective for his estate planning. If I look at then, maybe if I dip into SSQ's world and they have non-participating whole life, and I maybe compare that to participating whole life, the premium is usually lower. So the cash flow requirement in order to fund a $1.5 million policy would be lower. And this is important as well because the advisor had done some retirement planning for this client and determined that, yeah, if we fit with sort of this budget, then that'll fit into the cash flow that can fund the insurance. The other side, if I look at the term then, there's flexibility that he wants. And he wants the flexibility to know that while he's working still in his practice, that he may convert that term policy because things may change, his objectives may change, etc. So again, when I think about the flexibility that's required in a corporate setting, that's what they're looking for. They want to know that they can potentially do different things. So again, term offers that flexibility. And again, efficiency of CDA. So if I look at sort of that traditional par that's participating, then my concern always is, do we have efficient CDA as opposed to another solution, maybe non-participating par or YRT or something that gives CDA quicker in terms of a time frame for our clients. So something to think about when we think about our combining term with permanent. So I asked SSQ, said, what's your term options available? And they have a whole host. So I like the fact that, again, everything from 10 to 35, etc. So I think that if you're looking at a solution that's on a term basis, that's something to think about. So again, some great options there. So let's look at the numbers then. Let's look to this 50-year-old client. They need $1.5 million of insurance. I look at a premium basis on a non-participating SSQ policy, the premiums of $39,000. I look at another company in terms of its participating whole life on a reduced dividend scale. Those premiums are higher, and there's a difference in terms of those premiums. The premium difference over that 20 years turns out to be about $264,000. Now let's look then at what the numbers look like near life expectancy. Death benefit on that guaranteed non-participating whole life on the SSQ side turns out to be 1.5, and perhaps the company 2 in terms of their death benefit at age 85 turns out to be 1.9. I go back to my tax brain in terms of where CDA fits into all this. CDA at age 85 is at about 1.5. And then on the other side of it, in the other company, it's 1.3. So you may say, okay, maybe there's an advantage in one side or the other. But remember, we have a premium difference. We have funded this in a different way with another company for higher premiums. So can I then take that premium difference and purchase a term 35 policy with that premium difference over that time frame? If I then look at what CDA looks like, well, then now I've got CDA well over 2.1 million because I've got efficiency from both the permanent non-participating and also the term. And I compare that back to our one solution side on the company 2 that sits at about 1.3. So I think there's options. I think it's really a matter of finding out your client's objectives and what they're looking for. Again, they want guarantees. And again, looking at CDA. And again, flexibility. So again, maybe it's a dual solution. Find out what works for your client. So in this client's case, he certainly was looking at having that flexibility that we talked about. Here's where I'll sort of end in all of this. Life insurance is an opportunity to have a financial tool, as we talked about in our whole conversation, of providing, being tax exempt, not being exposed to accrual taxation, and it provides liquidity and flexibility when it's most important. So again, when it's most important, does that mean where you have, Michael's situation where he needed to make sure he had the insurance? Is there a tax liability? Is there a way to diversify and still bring liquidity? Clients that have, when you do their net worth statement and they don't have liquidity because they have so much real estate, etc. Again, planning is all about the opportunity to present options for your clients. And I think there's a way to present it in terms of showing potentially strategies, etc., as opposed to just showing the illustrations. So that's where I sort of sit today with you. We talked a lot about how the estate looks. We have how that folds into the corporate setting, some of the case law that's out there, and again, your opportunity to use some of the strategies that are out there, and SSQ has those. And so I encourage you to think about your clients, gather those net worth statements, and then perhaps then think about doing some good estate planning for them. And does that involve insurance?